Hey everyone, have you ever wondered how to invest so you get increasing income as well as capital appreciation? Well, as an investment actuary with over 10 years of investment research experience, I've seen my fair share of investment strategies. So join me, because in this video, I'm going to run through dividend growth investing and explain how it can apply to your life. So let's get into it. Dividend growth investing is investing in companies that not only pay dividends, but those dividends increase over time. So not all companies pay dividends. A lot of them either use that cash to reinvest back into the business, or they buy back their own shares. So it's quite a small proportion of the investment universe that would actually pay dividends, and then it's an even smaller percentage that would pay regular increasing dividends. So dividend growth investing seeks to capitalize on finding those companies that have regular increasing dividends and building a portfolio so that your investments will pay regular income. So in my experience in institutional investing, this isn't a very common investment strategy. And that's because in the institutional world, there's more of a focus on capital appreciation, meaning that we would rather companies buy back their own shares or reinvest into their business because that cash flow is not needed. And also what you find is that if you're looking to build a diverse strategy, that by narrowing down the investment universe into companies that only do regular increasing dividends, you're actually increasing your concentration risk quite a lot there. So that's something that we want to avoid. This means that this is a strategy that's typically used more in the retail space, so for individuals who are looking to generate regular income from their investments. Dividend growth investing typically targets companies that are very large and stable, so companies that might be a bit safer than other companies that are on offer in the equity market. And that's because basically to commit to paying regular increasing dividends, you have to have a very stable, strong revenue stream that's ideally growing over time. And you hear stories of companies like Tesla that didn't even turn a profit for the first 5 or 10 years. So this strategy definitely causes you to focus on companies that are very large and stable and that have a very good business. So why might you do dividend growth investing? So as I mentioned, it's essentially if you need regular income from your investment portfolio. So typically this would be if you've retired and you don't have any other income and you're looking to generate income from the capital that you've accumulated. So what you do is you invest that capital into some dividend paying stocks, for example, and over time you would get the income, but you'd also get the capital appreciation because the stocks should go up in value over time. So the growth part might be particularly important for you because, one, if you're retired, you're not going to have any other forms of income, and because of inflation, the cost of things might go up over time. You're going to want your income stream to go up over time to manage against your liabilities. Also, you might have retired early and you might have other alternative income streams at the moment, so you basically have less of a requirement for capital now. So in the future, you're hoping that your dividends will be more and you can kind of tone down that other source of income that you might have at the moment. In my previous video about passive income investing, I kind of highlighted a number of other strategies you could do to generate income for your investments, but a lot of these again don't allow for capital appreciation, which is another good part about dividend growth investing, is that the principal that you invest should grow over time in line with the stock market, or maybe slightly behind, just because the stocks are slightly less risky. So that might be better for you than buying an annuity for something or investing in cash, because you're not getting any capital appreciation there. I guess the flip side of that is that you could lose a lot of money doing the strategy as well. So particularly in the pandemic in 2008, stock market sold off a huge amount and you could have seen quite severe capital losses. So the idea is that this is a long-term strategy. You don't sell even if the market's tanking. And the interesting thing is that even if the value of your investment has fallen by 30%, you're still going to get the same dividend income. So if you just close your eyes, don't look at the market and just keep getting that dividend income and don't sell, you'll definitely just ride out any kind of storm that you might see coming. So how might you dividend growth invest? So as I mentioned, you could invest in stocks that pay a regular and increasing dividends. I think some people call them dividend king stocks. And these are companies that are very stable, pay a very regular and increasing dividend and have committed to that over time. It's a big deal for a company not to pay their dividends if they've committed to it, and that can obviously very adversely affect the share price and the perception of the company. So once a company's committed to paying a regular increasing dividend, it's very hard for it to go back on that. So you can be quite confident in the companies that are already paying regular dividends and that they'll continue to do that going forward, provided their business model is stable. So yeah, the first way you could do it is just build a basket of these stocks. You could screen for the dividend kings and invest yourself. The benefits of that is you don't have to pay any fees to anyone, but the downside is you might be running a bit more risk and it takes a lot more time. Another way you could dividend growth invest is look for ETFs. So there might be some ETFs out there that basically invest in these stocks for you and you get a very diversified portfolio. and you might get slightly less dividend income that way, but you've got a bit more, you spread your risk, you've not put all your eggs in one basket. The costs tend to be quite low because it's very passively managed, it's all managed rules based, so there are lots of rules for inclusion in the ETF. One of the rules is probably, does the company pay a regular increasing dividend? And if the company does, it automatically goes into the index and you can just invest in that index. Yeah, the downside is that you have to pay some fees. And then the final way you could dividend growth invest is invest in a mutual fund or an actively managed fund that pays regular income. And the advantage there is that it's not rules based, so you've got an actual portfolio manager typically looking at the investments that go in the portfolio. However, these funds tend to be very expensive, particularly for retail investors. So I think most of the time people will go for the passive or buying stocks direct approach. So there we have it. That was my video on dividend growth investing. I hope you enjoyed it. It was a bit of a new strategy for me. I can't say I dividend growth invest myself, but it was fantastic to learn about this strategy and the benefits it has. So if you want to hear more from me, don't forget to check out this video here. Thanks.